In this problem, we will calculate the SUTA tax. So we will not only obtain the taxable earnings for SUTA, but we also apply the tax rate and calculate what the tax is for SUTA. The problem reads, A1 Freeman employs 3 workers who, as of the beginning of the current pay period, have earned $8,550, $8,200, and $7,400. Calculate SUTA tax for the current pay period if these employees earn taxable pay of $1,000, $1,350, and $1,800 respectively. What is the SUTA tax? So the approach to this problem is to lay out the pay for each employee, and there are 3, so we will label each as employee 1, employee 2, and employee 3. The prior year-to-date pay for each employee is given in the problem, so let's write those down as well as the current pay, which is also given. Add the prior year-to-date to the current pay, and we arrive at the current year-to-date pay. What we need to do is compare the current year-to-date to the SUTA tax threshold of $8,500. The reason is that taxable earnings above the threshold will not be subject to SUTA tax. Then we want to see how much of the current year-to-date earnings is over or under the threshold. Employee number 1 has current year-to-date earnings of $9,550, which is $1,050 over the threshold. It is significantly over. As a result, possibly the earnings was already over the threshold in the prior period. We check this by comparing the amount over the threshold of $1,050 to the current pay of $1,000, and since it is higher than the current pay, it actually results in a negative value of 50 when we take the current pay of $1,000 and we minus the $1,050. This confirms that the earnings was over the threshold in the prior period, and hence, this period the taxable earnings subject to SUTA tax is 0 for employee 1. Now for employee 2, who has current year-to-date earnings of $9,550, and that is $1,050 over the threshold of $8,500. So we want to exclude $1,050 from the current pay of $1,350 because $1,050 is not subject to SUTA tax. When we exclude $1,050 from the current pay of $1,350, we arrive at taxable earnings of $300. Employee 3 has current year-to-date earning of $9,200, which is under the threshold of $8,500 by $700. So we must exclude $700 from the current pay of $1,800, and we arrive at the taxable pay or earnings of $1,100. We sum up the taxable earnings of the 3 employees, and we apply the SUTA tax rate that we assume for this class, 3.4%, and we arrive at the solution for this problem, $47.60.